right, welcome everybody to Private Equity CXO's latest webinar. I'm excited to be back here hosting another panel for you all, so thank you all for joining. Today's topic of how to diligence your next PE-backed C-suite role can seem like a fairly simple concept, but it's a serious topic, and it's often the difference between joining the right business and leading a successful exit versus joining the wrong one and needing to find a new job after only 6 to 24 months, which is just painful for everyone. So we're going to be attacking this topic from two different angles. The first part of the session will be providing a lot of the executives in the audience with the tactics, tips, best practices to run proper diligence when interviewing for PE-backed roles. Then we'll switch gears during the back half of the session to discuss all the ways that private equity firms can help support executives in their diligence efforts to build trust and make smart hires. So we are here on Private Equity CXO, which is the world's largest digital community of private equity-backed executives. We've got 47,000 and counting. I feel like that number just keeps going up every time I host one of these, which is pretty cool. My name is Joe Gravino. I'm a principal at Falcon, which is a retained executive search firm that focuses exclusively on helping PE sponsors recruit CEOs, CFOs, and heads of sales and marketing at their portfolio companies. Before I introduce our panel, there's just one housekeeping item to mention. There's a Q&A portal where you can submit your questions, and we'll prioritize getting to a couple of those throughout the session, so don't be shy submitting those. So I'm very excited to introduce this panel today. I mean, the way that we built the panel was to intentionally get perspective from various functions. So today we've got CEO, CFO, and CRO all covered. They've led a combined 5 successful private equity exits and have worked with a total of 10 different private equity firms. So the panel recognition is off the charts, and all three have done a really nice job at picking winning deals, which is why they're all here today. So in no particular order, we'll start with Mike Parks. Mike's a 2-time PE-backed CEO with lower mid-market software companies. His first CEO stint was with a company called Inkling, where he helped Marlin Equity scale that business and successfully sell it to a strategic buyer. Shortly after that sale, he was recruited by Resurgence Technology Partners to become CEO of their platform called MCIM, where he's still at today. So, Mike, welcome. Happy to have you.
Hey, thanks so much, Joe. Really appreciate it.
And then next up, we got Hans van der Meulen. Hans brings experience as a finance leader in industrial distribution and logistics businesses ranging from 200 million to $1 billion in revenue. He cut his teeth working at Syncron for 18 years with Gen X 360 before being recruited by Bertram Capital to join Flow Control Group back in 2019. 2 years into his role at Flow Control, he helped them lead a successful sale to KKR, where he continues to partner with them today to keep driving the business. So, Hans, welcome.
Thanks, Joe. Happy to be here.
And then lastly, we've got Eric Bloom. So Eric's a 3-time PE-backed CRO with lower mid-market software companies. He spent a number of years working with Zywave under Vista, Aurora, and Clearlake. And then until in 2021, he took his first CRO role for a Spectrum equity-backed business called Ease. Within 2 years, he sold that business to a strategic buyer. Shortly after that, he was recruited by the Riverside company to join Modern Campus as CRO, where he led that successful sale within an 18-month period. So you're starting to get the gist here. Now today, he's the CRO at DriveCentric, which is a Summit-backed business. And Eric, we're excited to have you here, man.
Great to be here, Joe. Thank you.
Yeah. All right, so let's just jump right into it. I think rather than starting high level, I just wanted to get right into the tactics of diligence. So with that in mind, what I'd love for each of you to share is your diligence checklist you use when interviewing. What are the top 5 to 7 most important burning questions you ask both the PE sponsor and portfolio company before taking the job? Mike, why don't you start us off?
Yeah, Joe, sure, happy to. So I'm an anal retentive bastard. So my framework is pretty simple, but it starts in 6 core buckets. So first and foremost, I really want to understand the market. What's the TAM? What are the macro tailwinds versus headwinds in that market? And then I try to build out a directionally correct but not scientifically accurate market MECO. So who are the players in the space? What percentage of share do they have? Who's growing? Who's the 800-pound gorilla? Who potentially is declining in market space? Then I look at the company that I'm thinking about joining in the market fit. Is it defensible? I use a framework called valuable, rare, inimitable, and readiness. Is the business ready to take advantage of the opportunity in the market? Then the model. So where do the margins come from? What's the customer concentration? What are the renewal dynamics? Then I really press with the board on what's the mandate, what's expected of the role, how is success measured, the company that I'm coming into, is it growth, is it fix, is it transformation? And then I really need to understand the management fit. So what is the dynamic with the former CEO or the founder? What's the board relationship? What's the structure of the management team? How many of those players could make it to an exit? And last but not least, the metrics. So what's the compound annual growth rate, the gross margin? Is it a rule of 40 or 50 business? What's the net retention and gross retention, the EBITDA margin? I love to look at CAC versus customer lifetime value as a thoughtful way to evaluate the healthiness of a business.
Yeah, and you obviously provide a lot there, and especially I think one of the key factors there is, especially in founder-led businesses, is the founder ready to, hand over the reins to the CEO? What does that look like? Is there going to be internal dynamics that you don't know about? So yeah, that there's a lot of nuance there, and I appreciate the you sharing. Eric, Hans.
Yeah, I'll kind of go. I mean, I think there's kind of a two-step process within every process, right? You got kind of your initial like speed dating. If you're in market or thinking about being in market, you're probably getting bombarded by a lot of recruiters and you're sifting through the noise, right? And so that's kind of what I call like your stage one diligence of trying to look at like what might be a potential fit. I have a list of must-haves in that category where I can kind of sniff through those opportunities really quick. And keep in mind, I'm in the SaaS space, so I'm dealing exclusively with software companies, which might be a little bit different dynamic than Mike or Hans. But in my world, my number one thing is great product. Got to have great product. Process and people will not get you where they are. A lot of times you'll hear from a PE company and they'll say something like, we want to triple our revenue in the next 36 months and so on and so forth. And they have a market lagging product and so on. So you could go in and engineer best in class, absolutely everything in that business. But if the product isn't world class, it's not going to get you where you need to go, no matter how good you are at your job. So great product is number one. Two is fast growing. I mean, the company needs some momentum, right? If it's stalled out, it's flat, unless there's a very, very distinct reason why, it's going to be really hard to energize that and double, triple, quadruple the growth, again, with just engineering internally. So the company and the product needs to have some momentum going in that you can further accelerate, but it can't be in a decline or a stagnant stage. That's a big red flag for me. The other thing is, what are the problems with the company? And I got to be 100% certain that I can fix those problems from my experience, right? This is where you got to put your ego on the side, get the imposter syndrome out of the way, right? And just be really, really confident that between my experiences, I've been there, done that, and the problems of this company are a perfect fit for what I have experienced solving. And I'm highly confident in being able to do that. And that a connection of those things will obviously, provide us the growth that we're looking for. And then lastly, just a realistic investment thesis. I just can't tell you how many times I've talked to somebody and they'll say, we want to quadruple the size of the company in the next 12 months. I'm exaggerating clearly. I want to quadruple the company in the next 12 months. Next question, okay, how do you plan to do that? And they're like, well, you just need the right leaders in there. And it's like, this isn't a realistic thesis, right? This is we're out of ideas and we're basically looking for somebody else's ideas. And so the entire thing is alignment between the ELT and alignment between the institutional sponsor, and everybody has to have very realistic investment thesis and a plan to get there. So at very face value, if those things are not articulated and clear, I have an instant red flag up and I'm probably not taking a second call.
Yeah, and those are all great. I've got one follow-up question because the amount of CROs or CCOs that I've talked to who are on the market because they're in a situation where the product isn't great or it's churning and they're trying to add sales on top of that, but it's just not a situation that they otherwise can continue to operate in. They missed the diligence on the product. So What are a couple of things that you do to really try to diligence that in an interview process to make sure that that product's
Well,
strong
luckily,
and is what they're saying it is?
yeah, luckily being in a seat for a long period of time, you get a pretty big network, and a lot of times you can find people in certain industries. And I do a little back channeling and start understanding, like, can you connect me with some customers or some people that we know in the industry? Get an idea. I mean, a lot of times people just have an impression of a company, right? Is do they have a positive sentiment towards that company, negative sentiment towards that company? I'll actually, the website's pretty telling in general. But really, it's diligencing and trying to connect with actual customers and ask them about their experiences, ask about the competition, when did they make the change, what was high on their criteria, how are they meeting their needs, service support, all those things. But I try to connect with actual users of the platform through leveraging my network to try to get that.
Yeah, I'd have to imagine that if you just ask for customers that you can talk to from the company, then just give you the good ones, right?
Yeah, they'll give you their top three most raving fans, right? And that I'd like to do much more of an independent search.
Yep, no doubt. And Hans?
Yeah, maybe the financial lens on this. I like to start out with asking them for the SIM, right? And what is the confidential information memorandum that the current sponsor bought them on? Just give me a copy, gives me a general idea of what products do you sell, what markets do you operate in. Look, realistic enough, it's always a rosy story, but at least it gets you a basic understanding because perhaps contrary to Eric and Mike, who are a little more product specific in their roles, a CFO or maybe a CHRO as well is rather company agnostic, industry agnostic to some extent even. So I walked into industrial distribution knowing very little about it. Right. So just to cover those basics, SIM is always a very interesting place to start. And then the follow-on question is a good conversation with the PE fund of what's the thesis you actually underwrote, right? What are the things that must come through for this investment for you to return what you wanted to return, right? To just have that clear understanding of what are the things we need to deliver on as a management team in a company, right? In the whole period. Have a clear understanding there. And it's remarkable how often you get a vague answer. Right. So, which I think we talked about red flags. To me, that's a big red flag. Right. Then obviously putting the financial hat on, look, tell me about your capital structure. Right. How are things structured? Do you have upcoming debt maturities? Right. Especially companies further out in the hold. Right. What does that look like? Well, what's your liquidity position? Are you generating cash? Are you burning cash? How do you think through that whole scenario? Because at the end of the day, it's one of the CFO's key responsibilities, I think. I always think, at least, that you make sure there's always enough liquidity to pay the bills, right? And to support the company getting to that investment thesis. Right. Then another key question for me is what is the PE sponsor's governance model? Right? How often do they get involved? What level of detail do they get involved in? Right? I mean, not just the board meetings, but also the more frequent interactions, especially finance team, right? You get an awful lot of ad hoc questions that they get from their LPs or whatever happens behind the scenes. How involved are they? Right? Do they have their own in-house consulting team like a KKR has in Capstone? Do they often engage third parties, right? Is it the McKinseys, the Bains of the world? How do you interact with those? How much latitude does a management team have? To me, that's a key question to really understand whether I like the role or not, right? And then I think lastly, what's the team like? What happened to the last CFO, right? Why is he or she no longer there, right? Why are we having this conversation? What's it like to work with the CEO? What's it like to work with the rest of the team? Because to me, and I think some of the colleagues here touched on it as well, is you got to work together as a team to get to the end goal. So those to me are the 4 or 5 key items that I would like to understand very well before going too far down the road.
Yeah, and I specifically like the point on private equity governance. I think that's often an element that's overlooked by a lot of the executive community, thinking that most private equity operates the same way, and they do not. You've got hands-on versus hands-off, operations focus versus finance focus, an overly prescriptive playbook-oriented fund typically is going to butt heads with a been there, done that CEO or CFO who wants to come in and run their own playbook. So that is a very important element, and we spend as much time educating the candidate community on private equity governance model compared to also the portfolio company and everything you guys said there. So I think the theme that the three of you mentioned, which I think ties one to the next question, is you guys all mentioned investment thesis and making sure that has a lot of specificity to it and also aligns with you know your background and your experience and skill set, and can you help them get to that next phase? So I think how do you each pressure test the true mandate of that investment thesis and of the role? To Mike's point, whether it's growth versus transformation versus stabilization. And as you're doing that, what are some of the red flags that you're finding to where it doesn't, you're getting the flags are going off that it just doesn't match and that things aren't syncing?
You want any of us to go first, Joe, or just jump in?
Yeah, go for it. Whoever feels
Yeah,
most
I mean, I think Hans said
passionate
it
about
really
it.
well, right? Like I think it's thoughtful to have conversations with different stakeholders across the firm. So whether that be different members of the board, but you want to make sure that they can all describe the mandate in the same way. Like any misalignment there would be a major signal or a red flag to me. I think it's important too, to Hans's point, to analyze the budget. If they say, "Hey, this is a growth play," but the budget and the debt doesn't support a growth play, you have to have that conversation as you're considering the role. Are there covenants that we're potentially going to trip? Like, what is our ramp to cash? And if we wanted to make thoughtful investments, what's the availability of additional capital? Whether that's capital to grow the business organically or potentially to make a necessary accretive acquisition over time. But if there's no clear plan for like backfilling mission critical roles, if there's go-to-market or product debt that is masked by like inflated forecasts, if there's lack of rev ops in a business, if there's a bookings plan of 4.5 million and you ask what's your win rate, what's your quota coverage, those answers don't make sense. There's just a lot of easy ways to get to is the investment thesis feasible or not? And then to the comments that Eric made, like I always look at what is my unique skill set I can bring to this business. And as a CEO coming into a company, it's probably the wrong way to think about it in the PE lens, but maybe not. I give myself 12 quarters, like I'm always racing. And what are the quick wins that I can deliver in Q1 or Q2? Because it's my job partnering with my CFO and CRO to build credibility with the board, right? As I start to show them the investment that we can layer into the business to drive better results, they're more likely to believe my story and become less of a push PE firm and more of a pull PE firm that allows me some freedom to grow the business in my vision opposed to theirs.
Yeah, I think it all goes to add on to what you said, Mike, and I think Eric touched on it as well. A lot of it comes to what's the strategy, right? I've scaled businesses twice over my career, starting at 100 million up to 2 billion, right? At this point in time, one was mostly through organic growth. The current one, we've done 100 plus acquisitions in 9 years, right? Of lots of small companies, but you got to make sure that your background lines up with that, right? I have never been involved in steep turnarounds, right? In some organization that has some massive commercial issue, for example. Is that solvable? Is it not solvable? How do you deal with that from a finance support perspective? How do you provide that business partner relationship to the rest of the executive team? And also, how realistic is it to turn that around? Right? Those are all questions that, to me, based on my experience set, I'd think twice before I would even take such a role. It could be very appealing, then have more conversations, dig deeper, right? Make sure you fully understand it, but line it up against your own skill set, your own experiences is the best advice I can give you. I have certain roles there. I go like, well, it might be a CFO role, but that strategy just doesn't align with what my experience set is.
Yeah, it's the job to be done framework where we start every search this way. What do you need this executive to do and execute in the next 12 to 24 months? List the 5 to 7 key objectives. And then we're going to lead the search with that. And we're going to list those out in a very transparent way to any executive that we're interviewing, just to be totally aligned as to this is what they're going to ask you to do. Do you have experience doing that? Yes, no.
It goes without saying, and I don't want to be duplicative to anything that Mark and Hans said because they all brought up fantastic points. I think when you look at an investment thesis, though, there's obviously a timeline attached to it, right? Are you coming in at the very front end? The PE firm just acquired this company. They might say 4 to 6 year hold period, you know, whatever, might be much longer. Maybe it's a quick strategy in and out. But you have to obviously know the timeline and where you are on that timeline, right? So if they acquired the firm 4 years ago and they're looking to exit in the next 12 to 24 months, you know, as far as that thesis is concerned and what you need to do and how you create value in that very short time period is much, much different than if you're at the very beginning of that hold period. And so I think like really understanding like what is the strategy? We talked about organic growth, inorganic growth. Do we have money set aside to make acquisitions where it makes sense? What type of acquisitions do you want to do? Is this financial engineering? Are you looking at a product line? Are you looking to add a new vertical or an adjacency? There's a lot to that. And do you have experience with that, right? Do you have experience in doing the diligence on those companies and integrating them into the business and the data mapping and all the things that go with it? If you don't, and that thesis holds, that's not the right opportunity for you, quite frankly, right? So there's a lot to that investment thesis. You know, we could probably have an entire show just on that, quite frankly, because from a financial side, there's an hour of content. From a market and strategy standpoint, there's probably another hour of content as well. But if you're looking for some quick hitters, it's just really kind of understanding holistically a very clear picture from that PE sponsor to the candidate of being able to articulate this is exactly how we see the world and this is how we want to go about it, and making sure that's in alignment with your skill set and desires.
Yeah. Yeah, we're getting a couple of questions here in the chat around more tactically, where in the interview process are you asking a lot of these questions? Up front? Is it in subsequent interviews? My view, and what I've seen executives do really well, and I'd love each of your perspectives on this, is they strategically use every single interview throughout the process to gain different perspectives to make sure that everybody is aligned on that investment thesis. And when talking to the investors, the operating partners, the management team, you get a really good feel for how aligned everyone is and if they're all rowing in the same direction. So anything to comment there?
Yeah, I think, look, to me, the key question of the sim and the early reconnaissance and what's the investment thesis, that's almost question one. I think I asked you and Rob that when you placed me. Send me a copy of the document, right? Yeah, I even asked that to the recruiter even before we get into any interviews to even get an idea of the base business, because as I said before, I didn't know anything about industrial distribution. Right. So to me, that's a very helpful thing. But the theme that I then went on is, okay, there was a clear defined strategy was outlined early on. And when you then start talking to CEO, COOs, and other people around the company, is everybody telling you the same thing? Right? Are we all on the same wavelength? And it's surprising how often you find differences there, right? Where the IT guy is working on some ERP conversion that somehow doesn't line up, right, with the M&A strategy. And then you go like, not so sure this will work, guys, right? Or we have high dreams of large capital investments in the fourth or the fifth year of a hold where you go, I don't think your sponsor might go along with that. Right. So those are all the red flags where you early on ask these questions. Some of the more tactical questions, what I have always done is I make a list of which of these questions do I ask who. I find it probably rather pointless to talk to the CEO about the liquidity position. Well, great if he can answer it, but most cases, probably not. Right. You're wasting his time. You're wasting your time in the interview. Ask that to the PE team. Right. When you get to the VP or even the partner on the case, ask them that question. If you want to talk about the markets and products and understand the viability of that, talk to the CRO, talk to the CEO, right? I think of the list that I have very targeted points to certain people, but then you bring it all back to that investment thesis and say, does this all line up?
Yeah, I think that's well said, Hans. I would probably disappoint you. Like I like looking at the cash flow forecast. I like thinking about where I can spend. Ultimately, as a CEO working with my PE firm, I'm typically working towards an EBITDA margin as opposed to an EBITDA dollars. So throughout the year, what are the big bets that I can make that can drive growth, that still drive that EBITDA margin? And as long as I do that, I've got some freedom to spend maybe it was not budgeted. But back to your question, Joe, the simple answer is early and often, right? Like I've been approached a few times about confidential searches. I've learned over the last decade that those are not for me. Like I want to know as much as I can about a business and a market before I go into the first conversation. And at the end of that first conversation, I'm probably going to send a thoughtful follow-up asking for metrics on the business, the value creation plan. And if they're not willing to share or they're hesitant or they view me as a pain in the ass, it is what it is. The opportunity is not for me.
I'll say I kind of look at it as speed dating, right? Like when you're talking to the recruiter for the very first time, you got a standard 5 questions you ask, and you're looking for a certain set of answers to determine, like, do I even have interest in spending more time? I'm more looking to eliminate opportunities than I am to find an opportunity. You find your opportunity by eliminating things that just aren't a good fit, or it tells you like nothing's a good fit at this time, and like the right opportunity hasn't come across the table, right? And so I have those speed dating ones initially, but then when it comes to the next round, I mean, typically your first conversation or interview is going to be with one of the somebody at the PE sponsor, right? And then usually your first interview with an operator will probably be with a CEO. And so I ask very similar questions, if not the same exact questions to the PE firm as I do to the CEO, and I'm looking for alignment in the answers. Like regardless of what the question is, I'm just looking for symmetry there because that tells me that there's good interlock between the operators of the business and the PE firm. And I think that's very, very important that you're not getting yourself into a situation of infighting or back talk or water cooler talk or all these things that could slow down the process of transformation.
Yeah, we've all seen where that misalignment slows down value creation. So yeah, any way that you can try to diligence that out in the interview process is always good. And so, the next question I have, I guess, in the first 90 days after accepting a new role, what are the most common things you all are finding you tend to miss in diligence? And how do you navigate that to still get off to a strong start to say, I missed this thing in diligence. I've got to still push forward and do a good job here. Hans, why don't you start us off?
Yeah, I think what I missed in diligence was basically CEO was there to stay. Partner stroke COO was much closer to retiring than the picture I built up. He was literally out in less than 180 days. In the end, not a big deal, right? Because the guy who came in was phenomenal and he's our CEO today, did a fantastic job, but I missed that point. I did not ask that specific question of, I mean, looking at the guy, you can tell like 5 years horizon probably turned out to be 180 days. So that was to me a learning lesson to say, hey, look, we have a very thin executive team. The company was a lot smaller than it is today. I probably should have asked that question.
No doubt, especially if you're a direct report to the CEO. I mean, yeah, what's
Well,
the saying?
CEO
Comes
survived.
in and yeah, you guys don't have a good working relationship, and then you're out. So
Well, CEO survived. It was the COO next to me, basically, as a
oh, the
peer,
CEO, okay. Yeah.
who very quickly bailed, but same outcome, right? I mean, it's the person you work with on a daily basis, and yeah, that was a miss on my part.
I think some of the, if you're going into a founder-led business, right, and it's a recent acquisition, you always have the question of what is the motivation of that founder because they probably just came into a significant sum of money, life-changing sum of money, right? And are they going to be there for 6 months, 12 months? Do they want to stay there in perpetuity? Will they have the same energy and rigor in this next chapter that they did in the first chapter? I think that's a very, very difficult thing to flush out, and nobody wants to, even if people know the answer, nobody wants to be very transparent about anything that could represent instability in the business. I think that's a very, very difficult thing. If it's a new CEO, it's obviously or an incumbent CEO that's been a while there that's not the founder. Then it just goes back to the normal alignment type questions. But I think I've had that situation where coming into a founder-led company, there's always been some surprises, I'll say, with the focus and energy of those founders post acquisition.
Yeah, I think they always have the incentive of the second bite at the apple, but once they think they want to be a private equity backed CEO until they actually learn what that truly means in the first two
Correct.
months of the role. And
The only
so
other thing I'll add, I'll just add in real quickly. In full disclosure, I don't have a good way to this day of figuring this out, right? But it's very similar in the attitudes and skill level of the people, your new direct reports, right? And really understanding like, their allegiance to the previous person in the role. What is their skill set and talents? How open are they to change? Do they want to change? Do they want to evolve? Do they want to modernize and all those things? So I've been in companies where you're welcome with open arms and say, thank gosh you're here, man, oh man, like I'm just ready. We've been boxed up and we're just ready to do great things. I've also come in companies where everybody says, nope, we've been doing it one way forever, and that's the right way to do it, and we have no interest in evolving, and that's a much tougher conversation. So, like, I still don't have a good way to vet out the energy and competence level of the team that you would be inheriting on day one.
Yeah, that's really well said, Eric. I don't have a magic bullet to that, right? I think that people are always the hardest part within leadership, and putting yourself in a position where you come into a business and your thesis on how you're going to help the company grow aligns with the team that is there. Like people go to work for people, they don't go to work for companies. And so understanding that allegiance is important. I'm good at self-deprecation. So for me, I've had two common misses throughout my career, Joe, and Eric touched on one of them before, and that is like I want to innovate. And if I come into a company and I've underestimated the depth of product or technical debt in that business, it can make that innovation cumbersome, right? I want to see 20 to 30% of my development capacity aligned towards like technical debt and code refactoring, and the other 70% for satiation of customers and new features. And I've been in businesses before where that's just not tenable. And then the question becomes for how long? And the second piece is just poor go-to-market infrastructure, or for lack of a better term, marketing readiness. And so I run now a pretty ground truth audit within a business. Within the first 90 days, I want to talk to every customer, do a really thoughtful review of the current state of the pipeline, the org, the talent within the go-to-market team. And I want to identify early wins because that helps me reframe the expectations with the board. And transparency is key in those conversations.
yep, no doubt. And then I think, switching gears, because we spent a lot of time in terms of questions you to ask in diligence. I think switching gears to the private equity side, you guys have worked for a number of different private equity firms. And then we're not even counting all of the countless interview processes you all have been in for PE-backed opportunities. So you've seen what's worked, what hasn't worked. So if you were to advise a private equity firm, what did the ones that you guys ended up going to work for do well in assisting you guys on your diligence? What materials were they providing? What were they telling you? How open were they? Walk us through just a couple of examples of the good versus the bad there.
Really good, I'll tell you. Like they can provide you the sim of when they acquired the business. They can provide you the market research that they did. They probably paid McKinsey $500,000 for a 80-page report that dissects the business and the industry, especially if you're not familiar with the industry. Proactively providing those sort of materials so you can assess the spot in the market and the opportunity ahead is extremely helpful, especially when there's some third-party research in there. I think very, as far as deliverables are concerned, obviously there's the value creation plan and the equity plan and so on and so forth, and you can vet through that however you want, but being transparent with that and more upfront versus hiding it for the 12th hour is obviously something that allows seasoned executives to decide, is this the right fit for me? Because there could be a lot of things that are a fit, but the financial profile just isn't a fit at the end of the day. But you waste a lot of time if you're not transparent about that. I'd say the other things that they can provide, maybe not physically, but just like we talked about before, really clear direction on the needs of the business. So I can know, can I attach my experiences of what I've done before directly to the needs of the business? I think, a clear opinion on the current strengths and weaknesses of the business, but also in the leadership team. So I can assess, how can I actually help that? Is there a unique value that I can bring to the executive team that you observe as a gap? And then we talk a lot about the investment thesis, realistic timeline, and so on and so forth. So people that package that up with a lot of confidence and are transparent upfront with it go a very long way into creating trust early in the process, in my opinion.
Yeah, I've seen examples of when private equity firms are not transparent. I've at least heard examples of executives who get into situations where, yeah, they didn't know it was a turnaround. They didn't know that the private equity firm withheld a key piece of information about the business. And my view is that, if you're a private equity firm and you're trying to recruit executives, you want to be as transparent as possible, even about the things that they're going to find that aren't great within the business in the first 90 days. Because when you tell an executive that, and if they shy away from it, they were never going to be your person to begin with. You want the person that hears that flaw and they say, okay, that's fine, but I'm running towards this opportunity. Let's go. So I agree. Transparency is always the right approach there. Hans, Mike.
Yeah, I can help a little bit. I mean, with my current partner, Resurgence Technology Partners, they've been fantastic. I mean, as I went through the process that you led for them, Joe, I mean, they gave me immediate access to like internal subject matter experts across finance, sales, marketing. They shared board materials, they shared metrics. It was a fantastic experience, and probably more impactful to me, they connected me to CEOs, CXOs at other portfolio companies, either former or current, to talk about their experience working with the board, which just gave me trust really quickly in that process. On the flip side, I've walked away from an opportunity where there was a more complex cap table where I couldn't get like clarity on who actually owned final financial decisions within the business, or to Hans's point, what the authority matrix was. And if there's ambiguity around who is actually the decision maker, who is the chairman of the board, who controls the purse strings, that's a hard signal for me that it's not an opportunity I'm interested in. There was a question in the chat from Chris Murphy I'd love to answer live. He asked, how do you ensure that the PE firm really understands the market that their portfolio company is in? And I don't know if this is the right way to say it. I'd love Eric and Hans's perspective as well. The simple answer is I don't assume that they do. I view that as my job as I come into the business to truly understand the market, and then working with my leadership team to educate my PE firm on the opportunity that we have to create enterprise value. I mean, the PE firm's job is cash on cash returns, and it's my job to deliver those for them. If I'm looking for my PE company to be a subject matter expert in my market, I'm probably looking in the wrong direction. I don't know, Eric and Hans, what your thoughts are there.
Well, the interesting thing I always like him to do is I don't expect your PE operating, even your operating partners, to fully appreciate what the company does. I mean, that's the end of the day why they pay a management team. But if they just recite the sim and can't go much beyond the sim, that is probably something to be worried about. Now I'm talking to a lender, and I'm actually not talking to a PE sponsor, right? That to me is a little worrying, right? Because at that point, if you can't go beyond that, do you truly understand the market the company works in? Do you truly analyze the problems, and how can you work together with the management team to actually create the value that the business ultimately needs to create for it to be successful for both the sponsor and the management team? Right. So that level of, I think, to answer Chris's question, is just keep asking questions. Right. Keep asking questions, open questions, not yes, no type stuff. Right. And force them to talk. And that way you can politely test their knowledge of the asset that they own, because you are correct. In some cases, especially the lending community, people don't understand what they invest in.
I
think
think
the PE sponsor side is a bit stronger.
Hans, I think that was a good answer too, and I think it depends on the individual, meaning us, the people in the seat. Some people want a very kind of operationally heavy-handed sponsor that's going to be very involved in the business and provide more of an operational playbook. Some people have zero appetite for that, and they just want to run very independently and quarterly, do your board meetings and kind of show up and give updates, and the institutional sponsor is not getting into the day-to-day operation. So there's quite a wide spectrum there. There's also obviously a lot of PE firms that have specializations in certain niche sectors where they might actually have connections that can be helpful to growth expansion or partnerships within the industry. So I don't think there's a one size fits all answer for that. I think it's personal appetite, and I think it might be a little bit specific on the type of company or industry that you're in.
Well, and if you take that answer, Eric, and link that back to the question where we started, right? What should a PE fund do to convince candidates? One of the things I think a PE sponsor should always do is lay out the array of support mechanisms they make available, right? Because having been at Bertram, a mid-sized capital fund, right, that doesn't have the same breadth of stuff available that KKR would have where we currently are, right? I mean, you have an in-house consulting department. What type of GPO deals can you take advantage of? Do you have an in-house capital markets team, right? Obviously, the stuff that KKR can get through the capital markets is stuff that middle market funds can only dream of, right? But highlight that, right? Highlight what you can do to help. What does your equity model look like? How deep do you go? Right? Okay, fine. Of course, as an executive, you expect to be in the equity pool, right? But do I have the wherewithal to attract talent to support me in my own organization, right? Do I have equity available to get talent in? How deep can I go? What's the philosophy there? I've seen sponsors that say executives and maybe one layer below. You've got KKR on the other end of the spectrum where everybody is a shareholder, everybody is an owner, all the way down to the hourly worker on the shop floor, right? It gives you a whole different perspective, gives you a different arsenal of tools in your arsenal to work with, right? So be very transparent on what's your philosophy there as a PE sponsor. It could make or break what people are looking for.
Yeah, I love that. Hans, one thing you mentioned we talked about earlier is private equity governance. What have you seen from the PE firms that you've worked for? How have they done a nice job of communicating their governance model, whether it's involvement, decision making, operating cadence? How do you guys get a feel for that throughout the process? I know we've had a couple of questions about that in the chat.
I've just asked the question point blank, Joe, and said, look, what are your expectations? Right? What is the cadence that you have with your portfolio companies? Obviously, we all have quarterly board meetings. I've never seen a PE fund that doesn't do quarterly board meetings. Right? But the next question is, what is discussed at these board meetings? Are they general updates? Are there proposals for decisions? When's the last time you had a strategy session with your board? Right? Have you never had one? Red flag, right? Questions along those lines. Then specific to the department is, okay, what do you expect monthly financial reporting? What do you expect on a weekly basis? You have people that want to see liquidity on a daily basis. You have people that say, nah, I don't care. I'd like to see that once a month, plenty. Right? How deeply involved do you get? And then I think the flip side question is, what's our authority as a company, right? What can the CEO decide? Where do we need to go to the board? What will the CFO position be able to do? Right. So again, it all comes out to asking questions. And look, I've seen great sponsors who naturally lay that out for you. Others, you sometimes need to just ask the question. I very rarely find that people dodge that question. I think it's one that may be overlooked and often not posed in the interview session. But if you bring it up, I've never had people dodge it.
Yeah, I think it's a good reminder too, as we're talking about the context of this conversation in terms of what PE firms can do to set themselves apart and attract leaders like yourselves who are fantastic. It's lead with the governance model, lead with your operating cadence, lead with how the resources, the support, everything that just creates the transparency around the working relationship, just to better inform you to make a good decision on if this is going to be a fit or not.
Yeah, and it's a two-way street because it's fantastic to know as a CFO that, hey, I'm stuck somewhere in insurance land. I get a bullshit answer from my broker. It's really nice to know that you've got an insurance specialist in-house at KKR who works for you. So not a broker with doubtful allegiances sometimes. You can call that person, you can sit down, and you get professional insight. It's fantastic to know that they have that because I'll be the first to say I don't know everything about everything, right? So it's really nice to know you have that network available. So sell the features you have, right? Is the best advice I can give to a sponsor.
Yeah. Mike, Eric, anything to add on that point?
No, I think you covered it well. I mean, having functional experts within the private equity company that you can call upon when you're going through some challenges in your business that maybe your team doesn't have their arms around is great. You know, asking questions around the governance model, the reporting structure, doing a 9-box with the board on the current leadership team. I saw a question in the chat around, like, oftentimes when new CEOs or CROs come into a business, you can see just a sweep of change throughout the business. So getting an understanding of the talent in the organization versus the remit, what you're trying to accomplish. Is this team, are they ready for the challenge in front of them, or is there going to be some chop on people? I think that's important to understand. Make sure you're aligned with the board on, don't come into a business and fall in love with your product leader to learn that the board feels that person isn't right for the business. Like, ask those questions early and often.
Then Eric, any final points there? This one's fully baked.
I think this one's pretty fully baked for time. I don't think I have anything inspirational to add.
There you go. Well, one question I do want to get into, and we've had some in the chat about it, and something I wanted to comment on. We could have a full webinar on this. Is the equity. You guys have all been presented equity packages a number of times. There are a lot of things to look at when assessing an equity package. Walk us through, what your checklist is when you're trying to diligence a proposed equity package and you're trying to assess the validity of it. Whoever wants to take it away can go for it.
I think Hans is going to have a much richer answer than I am. I can just
yeah. I feel like I'm going to give you my answer, and Hans is going to say, "Here's all the things that you missed, Mike."
Yeah, totally.
Well, it's scar tissue from our negotiation in 2019, Hans. So
yeah, but
I think it was a big.
Sorry, go ahead.
It was a big part. It was indeed a big part. Sorry, Mike. Yes, but I mean, the end of the day, look, get the model, right? Obviously, there's a model that the sponsor underwrote, right? And don't just take the model for granted, right? Figure out, sometimes, accidentally or on purpose, did they give you the upside scenario? Did they give you the base case scenario, right? Is there a stress test on what if we get a massive market downturn, right? What does the equity model look like? Right. So first of all, what I always ask people is, if they send it to me in PDF, maybe that's the finance nerd answer, but if I get it in PDF, that's a red flag. Give it to me in Excel so I can play with it. Right? I mean, be transparent and run those scenarios and convince yourself that the equity model is actually achievable. Right. And that goes to me, that's the synthesis of all the questions you've asked, right? You've asked about the market position. You've asked about the investment thesis. What do I believe that needs to come through for this return to be realized, right? If I don't have a clear answer to what I do need to believe, then it's never going to work. Secondly, understand the capital structure, right? There's a difference, massive difference between preferred equity and common equity, right? If you have options on common equity and your sponsor sits ahead of you with preferred equity, accruing some big dividend coupon, a large amount of value will never see the common equity. So understand these things, right? If there is a pref structure, let's make sure you understand that. Understand the provisions of the shareholder agreement. If the sponsor puts more equity in, do you dilute as an option holder, or is there a make-whole provision? Right? Go through all these rather technical things. And maybe as a CFO, I'm a little advantaged here in these type of diligence questions, but I have no issue, and I've talked to many other recruitment processes for fellow executives who join at some point. I don't mind that they bring an advisor along, right? Get your own advisor. As a CFO, I end up explaining these things very often if we're in the process of recruiting a CRO, right? Let that person bring their advisor, get them comfortable. But I mean, understand all these very technical things, because obviously the PE model is your base wage is not why you join, right? It's the equity package really why you join in most cases. So make sure you are comfortable that the equity package has a realistic chance of paying out.
I think one of the things that Hans probably wouldn't overlook, but some might overlook, would be, looking at the valuations of when the company was acquired, and then the assumptions of those valuation multipliers over the life of the business. They acquired a business at 25 times EBITDA, as an example, right? does the investment thesis also assume that they're going to exit at 25 times EBITDA? And what has happened along the way that would bring those valuations up or down? If margins increased, has growth increased? What does retention look like? Like, we should know the levers that are going to increase that or increase or decrease that valuation, but take a look at what the experience with the businesses has been and have a realistic idea. Has that valuation multiplier stayed true? There's things that we can't control, and that's the appetite of PE firms in the current market, and is it a frothy time or not? We can't control those, but as far as how you would evaluate a business internally, because if it was purchased at a really high valuation, the investment thesis should have some contraction built into it, right? Or have clear areas that we need to solve to increase that valuation. I think that's one thing that's overlooked, where you get to the finish line and it isn't where you expected it to be. And a lot of it is because the starting point was much higher than the reality of today, if that makes sense.
Yeah, that does. And it's a lot of what we see in the market and what we've been seeing over the last couple of years. You have a lot of executives that are, 3, 4, 5 years of the whole period from deals that were bought in 19 to 2021 at the height of the market. And now that the market isn't as favorable and their companies are lagging, they're trying to forecast, okay, we're going to market in the next, call it 18 to 24 months, but I have to grind my way there for an okay liquidity event, but not anything close to what they originally thought, because companies were bought at the height of the market, and it's just tough to execute your way out of that.
Yeah, so a lot of times when they talk about the investment thesis, it's not getting to an ARR amount, it's not getting into an EBITDA amount, and so on and so forth. A lot of it is going to be based on the expectation of the valuation, or the expectation, the multiple, if you will, which is originally going to be based on the entry multiple.
Mike and Dad.
Yeah, I feel a lot better about my diligence after Hans's answer. So I always request a modeled payout, looking for a 2, a 3, a 5 times. I requested an Excel to his point so I can play with it. As a CEO, I like to really understand the cap table, and whether it's stock and options or PIUs or RSUs, is there a percentage that's held in reserve so that as we make changes to the leadership team, we have equity that we can grant those folk, meaning between myself and my CFO, do we control a portion of that table? Or every time that we go to an equity grant, are we diluting the pool, and what is the impact to the business as we do so? I also want to make sure that we confirm whether the equity incentives reward true value creation. And so, to Eric and Hans's point, are we trying to get to a rule of 40 or a rule of 50? Is the thesis that we will sell on a multiple of revenue or a multiple of EBITDA? I think both of those things are important. But more than anything, to me, it's 2 pieces. First and foremost, it's treatment on exit, especially around like single versus double trigger, participation threshold. And then also, how does the firm talk about equity philosophy? Like, is this really a wealth generating opportunity for the leadership team, or is it a retention tactic? I think that's important to poke on.
Yeah, because I think if you're not careful, a lot of executives can fall into a scenario where a private equity firm puts in a certain dollar figure at exit, but you need to get a 10 times cash on cash return to get there. Is that realistic? Yes, no. A lot of the times it's not. But I love when, and to both of your points, requesting it, the model in Excel is always the best. That way you can go and play with it. The best executives I've seen love to get it in Excel, and then they will, instead of having the scenarios already baked out for them, create their own scenarios based on where they think they can grow the business, based on all of the that they've learned about the business through the interview process and things like that. So, to your point, understanding vesting schedules, whether it's time-based, performance-based, a mixture, tax treatment, capital gains versus ordinary income, that's a massive difference. So there's a lot there. I guess one question we got here, which is interesting: how do you guys balance, as you're thinking about your offers, and it obviously depends on the part of your career you're in, balancing cash versus equity and how much you're willing to trade for that in various scenarios?
For me, it's just a spreadsheet and time to value. So what are my opportunities to earn based on opportunities that are strategically interesting to me? And over a 3 or a 4 or a 5-year horizon, how do I work to earn, to learn, and to create wealth for me and my family? And so over time, which of those opportunities in a 3 or 4 or 5-year horizon has the best payout? I try to evaluate cash plus equity in that lens.
Well, and I think another key point, Mike, is what's the likelihood of the payout and what's the time frame for the payout, right? Are you coming in mid-hold, right? Are you coming in year 3 or year 4, where you have a pretty short path to an exit, right? Pretty quick wealth generation. You might be okay to take more equity because you have less uncertainty. It might be a smaller time window, right? You get better visibility to what it takes to get there, right? So your likelihood of that payout might be greater than a company where you're 5 years out, you're early on in the hold. Now, you have more flexibility, you have more levers to pull, you have more time, right? So build all these factors in, but I can only agree with you, Mike. I mean, at the end of the day, it's a spreadsheet.
Yeah.
It's a spreadsheet. It's a net present value calculation on what do I believe on a probability weighted basis is the best outcome for me.
Yep. But to your point, like coming into a business, there's probably a list of gotta believes. What are the value creation activities that I can take to generate, whether it be EBITDA or growth, that gets me north of the investment thesis? And then over the course of the next 2 quarters, 4 quarters, 8 quarters, am I in the business on path to achieve that or not? Like I should be able to every quarter looking at my OKRs and the growth of the business determine if I'm ahead or behind. And if that's not true, as a CEO working with my CFO, we've done something wrong.
Then Eric, anything final to add?
Yeah, I mean, I really all good points. I mean, I might have a more simplistic way to look at it, but I mean, the reality is that there's a market value for your services, right? And I try to not press the top of it, but I'm certainly not going to accept the the bottom of it. So from like a cash comp standpoint, I mean, I'm very aware of what my costs are relative to my experience, and I don't really negotiate against that too much. And I'm transparent about that up front too, because if that's not a good fit, then that should be something that's spoken early. As far as the equity side, to Hans's point, like, I'll get that spreadsheet and I might rejigger it a little bit based on what I think is realistic, right, and not opportunistic. Obviously, upside is great, but focus on realism. And I just have a little formula in my head that says, what does this have to look like by year for it to be a single, double, or a home run, right? Um, if if I'm there for 3 years and the payout is Y, that averages to a certain amount per year, and in my head that says that's worth my time and energy. Um, you know, I probably wouldn't be too excited about signing up for something that's modeled at a single, right? A double, I could get excited about different aspects of the business and sign up for it. Home run, that's when I get really excited and, press upon those opportunities. Does that make sense?
Yeah, it does. And look, I think that's the right way to look at it. That's always the way I advise executives look at it, especially too if you're joining a company that's later in the whole period. Eric, very similar to the situation that we had with Modern Campus.
Yep.
I think there's always an element of a business where if it's 12 to 18 months out from an exit, they have an eye for profitability, an eye for cash. Every single dollar you take in cash is going to eat away at the EBITDA margin, and ultimately, the amount of equity you're going to get at exit. So there's also part of that game to understand as well. But yeah, to answer to bring it full circle, model out obviously the likelihood of exit, when you think it's going to pay out, how much you think it's going to pay out at, and that factor that in as you're modeling out how much cash you want to trade for that opportunity.
Yeah, and I mean, just to be transparent, I typically don't trade cash for equity. I have a cash value and I have an equity value, and I don't horse trade.
There, right?
But others might see that differently.
Yeah, it's all case by case basis, but no, that's good. Well, I know we're practically at time here. I just want to say thank you all for joining. Eric, Hans, Mike, thank you guys for your participation. Audience, you guys were great in terms of questions and trying to drive some of this conversation. So appreciate that. You guys can all find this recording on PECXO. That'll be there. It's evergreen there. So check that out. Eric, Hans, Mike, you guys are on LinkedIn. So if anyone wants to follow up with them on anything, then you know where to find them there. And but no, appreciate everybody. This has been a great conversation. Hopefully everyone that joined in got plenty of context and an education from it. I know I learned a lot. So thank you guys.
Really appreciate you having us.
All right. Signing off.
Thanks for the opportunity. Thanks, Joe. Bye.
See you later.